Happy Monday! The news day continues here on One News. Now I'm Danny Laurel. Let's take a look at the equity space after that exciting bull run last Friday. You can see here how our markets, or at least our index, has moved from September lows into where we are right now, which is 7,051. So if you're above 20% from that depressing low, you're actually into a technical bull run, and that seems to be continuing this morning, up by 1 4/10%. So a lot of good things did happen on Friday that finally pushed us into that territory. First of all, we did have a lot of net foreign buying to start this 2023. We've already got $12.9 million worth of net foreign buying. We're up by close to 6% year to date, and of course this came on the back of the BSP giving some color into the possible end of the tightening cycle, or at least softer tightening moving forward. You've also got China's border reopening and even some peso strength. A quick check on our market movers this morning and which ones are giving us even more steam ahead of the trading week. You've got MPIC, big performer here, up by 4 3/10%. They are mentioning that they're considering a delisting, but what would that mean for investors? So a lot of things to be parsing through here. You've also got BDO and Ayala Corporation following suit, but on the downside, you've got three sitting out this exciting morning: URC, Mondanisan, and Emperador. Incidentally, they seem to be three consumer stocks. And now let's check in about whether these bulls have enough rage to keep running. And we have with us this morning Sandra Araulio, CIO of Atram. Good morning, Sandra, and welcome to the broadcast.
Good morning, Danny, and good morning, everyone. Thanks for having me.
All right, Sandra, so a very exciting time, at least for the index, the past couple of trading days and spilling over into this week. But tell us, is this, just pent-up excitement finally happening here, some catch-up and some bargain hunting that spewed this rally? Or if you take a look, at the long term, is this something that is fundamentally driven by a real recovery of the economy?
Okay, those are a lot of questions. I think from the third quarter of last year, the pricing of the market is really far away from where value is. So the valuations driven by where earnings were coming out in the third quarter were really pointing to fair value of where we are today.
Okay.
Actually.
Okay.
So I think that's what's being reflected, and it's a good thing. The question of whether this has legs is really one of moving into 2023. What are the earnings expectations that we're expecting from corporates? And broadly speaking, we're expecting double digit, no? So 15 to 20% for index names. And if market price is reflective of value, then it's reasonable to expect another 20% up for the index.
Okay, so what is the momentum going? Because, it seems to just never end, at least, 5% already in just the past 3 days. Is there going to be a ceiling wherein people are going to start profit taking, at least in the short term?
Well, yeah, we do think that we are hitting resistance levels. So it remains to be seen, it remains to be seen whether the momentum that global markets have put our own market on as we started the year has more wind behind its sails. In the US, you're getting some data that is pointing to slowdown in inflation, which is emboldening risk takers to bet that the Fed will at least backtrack on its hiking, and therefore a recession can be avoided in the US. That's the best case scenario. You rein in inflation and you don't stifle growth, which is like this Goldilocks scenario that's in the very, very short term what markets are pricing in. Whether or not that is the actual case for the rest of the year, again, we're gonna have data that will follow, and it remains to be seen.
Okay, now, you did mention you're looking at 20% upside in terms of earnings growth. Why is this so disconnected from, the downgrades that we've been seeing in terms of GDP growth, where some are even expecting below 5%, that it will not reach the government's target of 6 to 7%. Where will this 20% of earnings growth come from? Are there specific sectors that we seem to be missing here that are not going to be affected by what you mentioned already, global slowdown?
Okay, so the ideally or in developed markets, the stock market does represent for a good part, or it captures the economy quite it captures it well, meaning it's almost a one-to-one relationship. For our market, you still have it's a partial capture, and we're talking about big corporates and how they are able to generate earnings from market activity. The PSEI doesn't quite capture the rest of the economy that might be cause of drag for for GDP growth. So just in fact, to your point that there have been earnings downgrades, 2022 had proven itself to be a blowout in terms of beating expectations. Last year, the view was because of the reopening of the economy. So of course, it did show on GDP growth. For corporates themselves, we were expecting 25% earnings growth. We actually delivered north of 40% for the whole year, just because of super low base levels. So while the 20% earnings that we're expecting for next year seems high, it had already been adjusted lower to account for the front-loaded, or for the recovery that we actually were more conservative about, but it did come in because of this reopening situation that we have for the economy. So there really is, while earnings growth, corporate earnings growth do point, or is normally used as a proxy for GDP growth expectations. For emerging markets like ours, there is only a partial capture, and it's really based on which names are being or which names are able to represent the economy
best,
well enough.
Okay, so it's not the basket is not fully representative, no? Okay, let's talk about a specific thing here, net foreign buying. We finally saw that come in the beginning of the year, but some are still saying that our multiples right now, so we're trading at 14.2 times, are still expensive compared to S&P 500, compared to the MSCI index. Tell us more about that. At what point do you think that the foreigners are going to be trickling back in, or is that going to be taking quite some time?
Okay, so from an apples to apples standpoint, just the market, we are not expensive.
Okay.
What is keeping foreign investors at bay, or at least the foreigners from coming into a very undervalued market, is the foreign exchange, because they're dollar investors. And while actually some appetite is coming back in because the peso has shown strength in the past quarter, which is why there have been some foreign flows that have been able to participate, or maybe had pushed the market as well in that 20% rally. So the question remains, or the view, or there has to be a view on currency. And given what's going on in the rest of the world, dollar strength is still pretty much a theme going into 2023 because of Fed policy direction.
Okay.
Yes, and
So
then
not out of the woods yet for the peso.
not quite yet.
Okay, now let's focus on one sector because you mentioned the interest rates, and on Friday, this was one of the ones that rallied properties. I'm talking about because of the fact that maybe softer rate hikes for 2023. What's your outlook on the property space, especially when we look at there's a lot of traffic going on when people go to the malls to buy, but the offices are still not necessarily hitting the vacancy or the tenancy levels with the work from home scenario. Is this a time to be re-entering the property market?
Well, I would say we're more on the neutral view with the property markets. So it depends on an investor's profile. Meaning, are you investing here for the long term, for the short term? Obviously, given where valuations are, your net asset value, I mean, the portfolio value of these property names are way above where market is pricing it at. So it's very much discounted at a high level. And that discount rate that's being applied is a function of where policy rates are. So by the time we're peaked in that discount rate, then that would be the bottom for that would translate to a bottoming out in the present value of the property portfolio. So I think there is still to your point, parang there's still an adjustment going on from the pandemic to the post-pandemic world. From a demand-supply standpoint, there is still an adjustment going on. But the reality is, property companies have already been adjusting to what they expect are changes on the demand side. And from a supply standpoint, there hasn't been new supply coming in. So that's also already being captured into property companies' portfolios.
Okay, so one sector to be watching out for at the moment, neutral, so depends on how you want to rebalance your portfolio right now, but definitely still want to watch, which is up by 6% and very rate sensitive at that. Thank you so much for your insights, Sandra Araulio, Chief Investment Officer over at Atram.
Thank you, Danny. Thank you, everyone.
For more updates, visit News 5, The Philippine Star, and Business World Online, or visit our website, onenews.ph, for more in-depth analysis. You can also catch One News on the Signal Play app. Register for a free account now. That's at www.signalplay.com, and stream One News live anytime, anywhere. I'm Danny Laurel. Join us again at 11:15 a.m. We are One News, all sides, all the time.